Welcome to our deep dive. Today, we're digging into an investment fact sheet. It's for a firm called Capital Alphabet.
Right. Managed by Vinu Velabhani.
Exactly. And our mission here is to pull out the really important bits for you, our listener, about their strategy, their performance, what makes them tick.
And this fact sheet, it gives us a pretty direct window into that. Their stated goals, how they operate, lots of data to work with.
Okay, so let's get into it. At the heart of it, Capital Alphabet seems to have this North Star, right? Maximizing long-term value.
Mm-hmm. And specifically, consistently beating their benchmark, the S&P 500.
So how do they say they'll do that? What's the strategy outlined in this document?
Well, what's fascinating is how clearly they define it. They're looking for, and this is their term, high-quality companies.
Okay. What does that mean in their book?
It means companies with substantial economic moats. So think strong competitive advantages, things that protect their profits.
Like a castle moat. Yeah, makes sense.
Exactly. Plus, they want high return on capital employed. So companies that are really good at making money from the money they invest.
Right. Efficient.
Very. And a huge margin of safety buying stocks for, well, significantly less than they think they're worth. And finally, companies run by trusted management.
That's quite a checklist. But then you get to these risk management rules, they really jump out.
Oh, yeah. They're bold.
Rule #1, never lose money. And then rule #2, only bet on no-brainers likely to beat index and long-term.
Never forget rule #1.
It speaks volumes, doesn't it? Very cautious, but also really ambitious. How do they square that circle? Never lose money in investing.
Well, the fact sheet suggests it's less about, literally never seeing a position go down temporarily and more about the intensity of their due diligence.
Oh, okay. So it forces a really high bar.
Extremely high.
Yeah.
It implies a super deep dive into the fundamentals of a business, prioritizing preserving capital through that margin of safety.
And focusing on stable, maybe cash-rich businesses?
That seems likely. Things less likely to get swept away by, general market panic. It means those no-brainers they mentioned have to be backed by incredible conviction.
Okay, so given that distinct strategy, those very striking rules, how does it actually stack up performance-wise? They started June 2022.
Yeah, and the performance, it's pretty remarkable on paper. Since inception, their cumulative return is listed as 133.35%.
Wow. And compared to the S&P 500?
The S&P 500 was 55.95% over that same period.
That's a significant difference.
It is. To put it in perspective, $100,000 invested at the start. With Capital Alphabet, it would be about $233,338 versus around $155,952 with the S&P 500 index.
And this pattern holds up year by year?
It seems so. The 2022 numbers are particularly interesting. Remember, the S&P was down that year, about minus 6.7%.
Yeah, tough year.
Right. But Capital Alphabet reported a gain of nearly 30%, 29.91% to be exact.
Okay, that really highlights the never lose money focus, or at least the strong defensive aspect.
Exactly. It shows resilience. And then strong gains continued in 2023, 2024, and the reported figures for Q2 2025 also look strong.
So those numbers are compelling, but you're probably wondering about the practical side. How do they actually handle client accounts? Is it a fund?
Good question. No, they use separately managed accounts, SMAs.
Ah, so individual accounts for each client.
Precisely. Held at Interactive Brokerage, or IBKR. This gives you, the client, direct ownership and transparency. You see exactly what's in your account.
But Capital Alphabet makes the trading decisions.
Yes, they have discretionary authority to trade within that account, following their strategy.
And if someone's interested, what's the barrier to entry? Minimum investment.
Well, they apparently lowered it. It's now $25,000.
Okay.
Though the fact sheet does recommend having over $100,000 for optimum results, probably for better diversification.
Makes sense. And fees, often a big differentiator.
Their fee structure is also pretty unique. It depends on if you're a qualified client under SEC rules.
Okay, so for those clients...
For them, there's actually no annual management fee based on assets. Zero.
Really? So how do they get paid?
It's purely performance-based. They charge 25% of the annualized profit above a 6% hurdle rate.
Ah, so they only make money if they make you money above that 6% baseline.
Exactly. And importantly, there's a high watermark, meaning if your account value drops, they don't earn performance fees again until it surpasses its previous peak.
Got it. Protects against paying for the same gains twice, and for clients who aren't qualified.
For others, it's a more standard structure, a 1.5% annual management fee charged on the assets under management.
Interesting. So two distinct options there.
Definitely.
So we've covered quite a bit here. Capital Alphabet's core strategy, the focus on quality and safety, those really bold risk rules.
And the impressive performance figures they report, plus the practical details like SMAs and the distinct fee models.
It's certainly a unique way of doing things in investment management.
Absolutely. Which leads to, a really interesting question for you to think about. How might a fee structure like that, one so heavily based on performance, combined with that explicit never lose money mantra, how might that genuinely shape the decisions an investment manager makes day to day?
Right. Does it push them towards safer bets? Or maybe towards taking big swings only when they have immense confidence?
Exactly.